Hi, everyone. Thanks for joining in. To quickly introduce myself, and then I'll let Manar introduce himself. For those of you who don't know me, my name is Rami Tabbara. I'm the co-founder and co-CEO of Stake. Quick background on myself. I've been living in Dubai for the last 16 years, and I've been part of the real estate market since then. So I moved to Dubai in 2006, and I've basically seen the ups and downs of the market, seen it mature over time. And just seeing how Dubai is developed into a global city with a lot of opportunities. And then Manar and I started the business, and our third co-founder, Ricardo. I've known Manar for 20 years. We went to the same school together and in Lebanon. And then we launched the business in January 2021. And we've had some fantastic results thanks to investors like yourself. And we see fantastic growth and potential in the Dubai real estate market. And we'll talk about that. We'll also talk about the current situation going around the world. We keep getting asked, how is real estate going to fare with the inflation that's going on, with the stock market drop and what's happening with crypto? How does real estate as an asset class fare? So we'll touch on that, and we'll also touch on, what are the future plans for Stake, and then obviously, please, if you have any questions, we'll have some time at the end to answer some of those questions. And if we don't get to it, please leave them in the chat, and we'll make sure to get to them. Manar, over to you.
Hey everyone, just quick intro on me in case you don't know. So I'm the co-founder and co-CEO of Stake. Partnered up with Rami around almost 2 years ago, a year and a half ago, since we actually started officially. I come from a background of investment banking and finance, and I follow the markets. So nowadays it's an interesting time to be in. As you can see, a lot of price action in the markets, and the big question on people's minds is, where do we go from here? And we're going to talk about all that on this webinar. I'm excited about that. I've also, just to complete the background, I've also been in Dubai for the last 16 years. Always in banking and finance. Very different world to retail, I would say, individual at the personal level investing. But I was always exposed to what Rami does on a day-to-day basis in terms of selling real estate to individuals across different markets, backgrounds, and really. We set out on the mission to empower everyone to participate in this market and to really improve the returns for all investors that come into the Dubai real estate market without, going into these traps that are out there. Usually we see a lot of investment flows into Dubai real estate for all the good reasons. But we really wanted to make a product for everyone to participate more easily, transparently, and to start making returns from day one. So that's what Stake is all about. I'll leave the welcome note to Rami to start off with.
So quick intro. Today what we want to talk about is where we are in the world, what we see happening in terms of the markets. As I'm sure most of you know, we've seen massive corrections so far this year across the S&P, NASDAQ. For those of you who've invested in Bitcoin, there's been a drop year to date, and over the last 12 months we've seen significant drops, some reaching over 50% on crypto. And over the 22 so far this year, we're seeing that performances all across the S&P. NASDAQ, that the drop has been some about 10, 20, 30, 40%. And most of the questions that we get is, how does that relate to real estate? What's happening with real estate, which we'll touch on shortly. Manar, do you want to jump onto this?
Yeah. So and what we've seen also in the past year or two is very popular kind of movements and phenomenons in the market, really, with the tech sector leading the way on the stock market mostly. We've seen major drawdowns, pullbacks from peak levels for these how do you say, darlings of the most recent bull market, really. You can think of, the FANGs having been, the big dominant players that have been the prime beneficiary of the bull market. But there's been a flurry of other names that have been beneficiaries of the COVID rally, really, post the pandemic and the monetary stimulus that helped prop that market. And we've seen, obviously, meme stocks, for instance, emerge as a kind of phenomenon on itself. Very popular names like the ARK funds and Bitcoin, of course, all of them really being the hardest hit out of the current state of play. And we'll talk about what's really driving that. But just to set the scene here, the names of the kind of biggest companies that we saw in the pandemic, from Coinbase to Robinhood to Salesforce and all that. These big names, even Uber, having 50+% drawdowns. Really, the average with this kind of popular name basket, with Shopify and Spotify as well. I mean, we have 91% drops in Robinhood and Shopify and Carvana. So these are pretty drastic times compared to where we were around about a year ago, when really no one prices people were paying for these stocks were relative to today extremely high. So let me set the scene here. What's the real cause behind all this this correction that's happening at the moment? When you take a step back and you look at what transpired during the pandemic, when the world shut, what the central banks, policymakers set out to do is to immediately kind of plug the gap in the spending of the economies to keep them running, to keep GDP from the recession from being more severely felt across the economy, across the jobs market, the unemployment market, etc. So from furloughs to programs to sustain employment, to checks, they call it helicopter money, checks in the mail. People receive their checks in the US and other developed markets to essentially go out and spend. So what the previous slide showed is the growth in the balance sheet of the Fed. So they basically pumped a lot of money into the system. The monetary base reached unprecedented levels as a percentage of GDP, and the federal deficit as well. If you look at kind of an extended period of time, from even here, the 50s, even your deficit as a percentage of GDP has really kind of shot up as of late. Really, primarily, as I mentioned, to create this demand in the market that was being, kind of impacted by the pandemic. So this liquidity really kind of found its way into the FANGs, as I mentioned before. The FANGs with an M, they made up the biggest component. These 5 names made up the biggest component of the S&P, really driving that 12% by kind of Q4 last year. Just these 5 alone were up 60%, and really the 495 other companies were only up about 3%. So we really kind of saw in many cases in bull markets, kind of a favored few that had the new thing. And then really these were the prime beneficiaries. These names were the prime beneficiaries of the excess liquidity that came to the market, really, from institutions to retail investors out there. Then also you have what happened is basically all that demand stimulus and that creating that demand in the market kind of wasn't met with a corresponding increase in the supply of goods and services. So naturally, with this much money and circulating, even if there were multi-decade deflationary forces that we've seen in the past, because we haven't had high inflation really for 40 years, inflation started creeping back up just because there was on top of it as well, what the Fed probably didn't anticipate is supply chain disruptions. Really from the pandemic, we expected those to happen, a lot less globalization, companies, governments looking for self-sustainable supply chains that are less dependent on cross-border. So many argue that we've reached peak globalization, and really that helped also, I would say, add fire to the fuel with so much demand and not so much supply really to meet that demand, meaning that prices across the board from all types of goods and services, from energy to rent to food and supplies to utilities, started kind of shooting up through the different indices of CPI and PCE, which is personal consumption, and that strips out basically the energy component. We then saw what we typically see, but much less so in the last 10, 15 years, the Fed having a low tolerance for this inflation, and the typical, kind of classic reaction to dealing with, more permanent inflation. Really last year when inflation was surfacing, the Fed assumed that it's going to be transitory. It's not going to be long lasting. It's a short-term effect of the pandemic, but it started persisting over time. As we recently saw in the last 6 months, it reached levels of 8 and 9%. And that raised concerns for the Fed to take action and start, just to firstly stop its accommodative measures and its balance sheet activities, basically by printing less money, buying less securities, bonds out there. What they did was start to increase rates, and that really kind of moved into the mortgage market very quickly. And we've had now, there's fears of a correction happening soon to come in the housing market due to the mortgage rates having reached multi-decade highs as well now, due to the interest rate movements really. So this is where we are today, and if you move to the next slide, you can see that really we haven't had this high an inflation in 40 years, as I mentioned. And usually when the Fed starts to tighten or increase interest rates, specifically this high, in this fast as well, it usually means a turn in the business cycle. The gray areas that you're seeing here are recessions, and you can see that recessions are mostly when interest rates reach high levels. And the big question mark, as kind of the previous slide showed, really is how far up will rates go to tame inflation? How far high will the Fed have to increase rates to deal with this roaring of inflation of our times?
So I'll jump into the case for real estate. And people always ask, is real estate a good investment class when there is inflation? And people know that real estate is a cornerstone of generational wealth, and it's an inflation hedge. And if you look at what happens with real estate, it's historically performed in line with public equities. So when equities are doing well, real estate is also doing well. There's a correlation between both private real estate and stocks. So today, over the last, when the market was hot, real estate was starting to pick up, and we saw that not just in the US in general, but obviously in Dubai as well. But we saw most of the pickup in Dubai real estate, as I'm sure most of you know, is right during COVID. And I just want to touch on that before I move to other slides. Is today, what Dubai did in the last 2 years during COVID was it really opened up the market and really helped the transaction volumes, which I'll touch on later, to get to where we are today in terms of a market. And I think the steps that the government took during COVID is why today the kind of the slowdown that's happening around the world hasn't really hit Dubai, and we don't envision it hitting Dubai like it has, or slowing down Dubai real estate like it has in other markets. The beauty of real estate is much lower volatility than stocks. As we know, you can't wake up overnight and realize that your real estate has gone to zero, while in other asset classes you can. And we look at the volatility of other asset classes, such as the stock market and Bitcoin versus Dubai real estate market. And here we mentioned the US real estate market. Real estate has a leading track record versus other classes through time. If you look at over the last 10 and 20 years, you look at real estate in Dubai has 6.6%. Over 20 years, it's 8.7%. While the stock market over 10 years is 10.9, but over 20 years is 7%. And if you just look overall in the market, and as well over real estate, is if you just, because it's a longer term investment, over time you have the capital appreciation that plays into play, but also obviously as well you have rental returns. And that's the beauty of real estate, is in times like this where we're seeing some uncertainty on interest rates, real estate becomes a great asset class because of its potential of capital appreciation and the fact that there's income. And I think COVID has taught us more than anything that real estate, or residential real estate, is more important than it ever was. And the fact that people are realize that a home is very important. You saw people buying homes, switching from renters to buyers when interest rates were low. As interest rates go up, people will decide, hey, listen, I probably won't take a mortgage right now, I'll rent, which is why the beauty of owning a rental home makes a lot of sense in times like this. Adding real estate enhances risk-adjusted returns. So including private real estate in your portfolio has historically improved returns with lower risk. So, you always hear us say at Stake that today we don't advise people to put all their money, or investors put all their money into one asset class. We really believe in diversity. We believe that if someone has $100 to invest, at least 20% of that should go towards real estate, and then the other asset classes can take the balance. But the reason why we say real estate should have an allocation within your portfolio is purely because of the fact that it enhances the risk-adjusted returns, and it's a much lower risk investment. And as I just said, it gives a competitive income stream. And if you look at average income over the last 20 years, real estate has outperformed the treasury bonds, the S&P, the 3-month T-bill. And we just feel that, the numbers of the dividends that you make, or the monthly income that you can make from real estate, something that's not seen in other asset classes. And one thing that we've seen from our product is what people love is the fact that when you invest in property and it's hassle-free, you actually are getting that income without the headache of actual property ownership and management. Only twice did US home prices fall significantly in nominal terms nationwide. So when you look at it, it was obviously in 2008, we all know that. That's when the prices dropped significantly, and then in 1932. And the reason why we'd like to highlight that is because as an asset class, over time, real estate is appreciating. And, obviously, yes, there are properties or real estate that you invest in or buy that will drop over time. And that's why, location is very important. The developer that you're buying from, all these play a role. And we're talking about here in general that even with all the drops and inflation and recessions that we've seen, home prices in the US have only fallen, prices fell significantly twice in 2 points. Dubai real estate, the property market today. I'm sure for those of you that have been kind of keeping in touch with the market or seeing what's going on, we've posted about this. Dubai real estate has so far been insulated from global market turmoil, especially over the last, I would say, 6 months. We've seen, the market really stay strong. Transactions have reached levels that we haven't seen, historic highs. I mean, May was one of the highest months we've seen since 2012, last May, and June is looking to end on a very high note. We see that the population of Dubai has increased just over the last year. We've seen over 100,000 people come in, which shows you that Dubai today, and this is why people ask, so why is Dubai different? And I think, the fact, and I said this just a couple of minutes ago, is obviously what with the changes that we did in the government did in COVID, but also the fact that people who were locked down in COVID and decided to come to Dubai saw how welcoming of a city it is compared to other global cities. And if you look what's going on in Europe with the Russian-Ukraine war and the uncertainty that's happening around there, and you look at how organized Dubai is and how open and opened up with allowing golden visas, which helped the real estate market. Today, people have come into Dubai and seen that, and Dubai has always benefited whenever there's uncertainty in the markets. Dubai stands to benefit. And there's one major difference. So, as I mentioned earlier, I've been in Dubai now for 16 years. So I was here in 2008, 2009 when the market did crash. And it crashed not because of a fault in the economy here, but obviously it was a global economic crash. And the reason why that happened at the time was the market in 2008, 2009 consisted of a lot of investors, where people would come in, put down 10% and expect to sell that property within 24 hours, sometimes a month, 2 months, and flip that property for gains. That changed. Back then, you can get a mortgage by putting down 10%. Today, the mortgage market in Dubai or the banks have tightened that. You can't get a mortgage unless you can buy a home unless you've put down a minimum of 20 to 25%, sometimes up to 30% today at some banks to get a mortgage. You also don't have as many investors as you do end users. And I think that's when in Corona, a lot of renters and people who've been renting in Dubai for so long decided, hey, listen, I see myself in Dubai for the long term. Let me switch to a homeowner. And all those factors have really insulated the market from the global turmoil. And I think today with the price of oil where we are, there's a lot of liquidity in the market, which will definitely help the real estate market here. Again, this really goes to what I was saying. Despite the added volatility, Dubai property values grow over time. Now, we still haven't reached the highs of 2014. We've seen in some areas prices go up by 50%, but the price increase that we've seen over the last 2 years is starting to stabilize. So prices that were going up 10, 15, 20% in some areas are now stabilizing, and we're seeing increases that are flat in some locations and some that are at 1% growth, which is very healthy for the market, because as we all know, when there's a huge or a quick increase in prices, people start worrying that there will be a drop. And I think that maturing of the market right now and that slower increase of prices is actually very healthy for the market. And the beauty of Dubai is the higher rental yield than most international cities. And if you look at how the market is gone, it started off very high back in 2002 when they started opened up the freehold, and all the way up to 2007, 2008, the yields were a lot higher. And I think that's starting to come down and average around 6.6%. Is what we're seeing today. And when you compare that to global cities around the world, such as New York, London, Hong Kong, Tokyo, all these Singapore, all these prime cities do not offer the same rental yield. And that's what makes Dubai a very exciting market. And when you look at value for money in Dubai versus other cities, you still are getting luxury property or property in the center, downtown of Dubai, for values that even are a fraction of what it would cost you in New York or London. And in my opinion, Dubai has a lot to offer and a lot more to offer in today's world than they did in 2008. And that's why we see that the yields in Dubai will remain strong and the prices in the residential prime rental market will remain strong. It continues to attract large-scale investment from all over the world, as we've said. So, today, the transactions, over 20,000 real estate transactions so far in 2022. We're expecting to exceed 2021, where we saw just over 35,000, closer to 37,000 transactions in 2022. And that healthy number will increase towards the end of the year. Expectations are for it to cross over 40,000 transactions this year, and that just shows you how healthy it is, the market. And there's a lot of money flowing in from Dubai, from places like new countries that were not investing in Dubai before, places in Europe. I mean, I've seen investors come on to stake from countries that I have never seen being in Dubai for the last 16 years. We would always get the regular investors from the GCC, from some places in Europe and Asia, but today we're getting investors from places in Europe that we never saw, such as investors from France. We're seeing investors from Scandinavian countries, and when we ask them, why are you investing in Dubai, they tell you, I'd like to start building a portfolio in a place where they've handled COVID very well, as opposed to how they handled it in my city. As we said, Dubai over year to date and the last 12 months has seen growth versus other asset classes such as the S&P, Nasdaq, Bitcoin, gold. Dubai real estate has outperformed all of these and stayed insulated from the global market turmoil. We'll go into the stake updates. Manar, if you want to take over that.
Sure. So this is just a quick recap to tell you guys what we've been up to. As an investor base, our user base has grown exponentially since we first started. Right about now, we have almost 34,000 users on the platform. We've also been busy distributing dividends. Those monthly dividends that Rami was mentioning is really kind of the key core value that we bring to your investment portfolio. Ultimately, really, we set out to distribute dividends on a monthly basis from the start. Rental income is actually ideal for that because it's paid in advance. In comparison to, like, for instance, even all the passive income type of instruments like bonds, which all kind of work with income being distributed in arrears. So you collect rent in advance, you can start to earn income faster from real estate, and we've immediately started paying from day one on our portfolio of properties. We also managed to expand our footprint globally. Dubai, as Rami mentioned, is a magnet for capital from all parts of the world, really, because of its growth, because of its value proposition, its infrastructure, and its overall kind of maturity and standing as an international destination for investment capital and real estate in specific. We saw a lot of demand during the pandemic come to Dubai, and that was for all the really good reasons for how the government here managed to handle the pandemic so well. So the footprint of Dubai has already kind of expanded during that phase, and we're seeing on the platform a mirroring of that. Really, we're seeing a lot of interest being generated across the board from individuals from 81 countries and 136 nationalities. And then lastly here, we wanted to walk you through some of the key considerations for why participating in real estate is actually better to be done on a platform like Stake versus buying an asset by yourself, a home, a property, or participating in certain other real estate investment products like REITs. And really the first to highlight is ease of access. Obviously it's quite easy nowadays to go on Property Finder and buy an asset by yourself. You even land in Dubai, you're going to find the developers out there and trying to kind of give you access to properties. but ultimately transacting in the properties themselves is going to be a bit of a hassle with all the paperwork, and then obviously the ownership hassle that comes along with buying outright properties. Really, in terms of access, stake is as easy as a few clicks, and we say you're able to complete an investment with under 3 minutes. So that's one of the key kind of considerations for why you would want to invest as easily as through your mobile phone. When you want to enter into REITs and let's say publicly listed REITs, you still have to kind of open up a brokerage account, get your national investor number, and go through certain hoops before you can start enjoying the returns of the REIT. And the private REITs are also quite inaccessible in that there's a minimum entry point, minimum entry amount to be able to participate in them. That's with the private REITs. So that's why the capital requirement is harder for private REITs versus kind of public REITs and stake, where entry levels are much lower. Outright ownership, of course, is the highest, because you have to really put up all the capital yourself for acquisition of the asset. When it comes to transparency and information that you'll be armed with at the onset before making an investment decision, it's high as it gets. With stake, we give you as much information as possible on the investment opportunity that goes online, from an info memo to financial projections. You know exactly what you're buying into, whereas when you're buying into REITs, you kind of removed from the assets, and the disclosures are very kind of firstly quarterly, but you would get very limited information. You're just one of many investors that are pooled together to own a bunch of kind of assets altogether. And when you're kind of buying an asset outright by yourself, there's a information asymmetry, we say, in real estate. The seller of the property, whether it's a developer or a secondary, an owner of a secondary home, finished home, he would know what the defects are with the asset, kind of like cars, if you will, secondhand cars. So they wouldn't be kind of prone to disclosing them. We do a thorough health check for all our assets that go on the platform before acquisition. So
I'd like to add one thing here is, whenever I've spoken to retail investors over the last 16 years who want to participate in real estate, there's three things that real estate investment entails, and that's capital, expertise, and time. And I think for someone to have those three is always difficult, and that's kind of why we founded Stake, because someone might have the capital but might not have the time or expertise. But someone might have the time and expertise but not have the capital. So by creating Stake and building a platform that allows people to invest it from a lower amounts fractionally and doing it in a matter of minutes, buying a property today is a long process. For those of you who don't know, it entails working. If you're getting a mortgage, that can take 60 days from end to end. If you're not taking a mortgage and working with a broker and buying it out cash, it also takes time and paperwork. Sometimes it probably can take 2 to 3 weeks. With us, we've really simplified the process. We've digitized the process. We've done everything in the background, the way we work with the land department, the way we work with the IFC, to really streamline everything, to make sure that your time is used efficiently when you want to invest in real estate, so that when you choose what property you want to buy, it's in a matter of minutes, taps through on our mobile phone. And we've really built a user experience for you where it's very similar to shopping on Amazon or ordering something from Tabbara or Deliveroo. It's literally a checkout, you have a cart, and you get out. And the fact is that why we solve for capital, so that solves time. How we solve for capital is we've lowered the minimums to 500 dirhams. So in times like this where there's uncertainty, we tell investors, you have a portion of whatever you have saved up and put it into real estate. And the beauty of the real estate right now is, if you look back historically, the fact of it just does such an incredible job of compounding returns through the dividends that we pay out. So even in times of uncertainty, you should create a second income, and that's what Stake does. It's your second income. And expertise for us is we have over 15, 16 years of experience in the Dubai real estate market. We have a fantastic board. We have a fantastic team that gives you access to that data. We do all the research for you. We go out, we look at the market, we look at valuations, We give you that financial reports that Manar was talking about. It's all transparent on the platform that allows you to make that decision. And one thing that we've taken a step further, I think we mentioned this on the last webinar, and for those of you who weren't on that call, is we've tied up with MIT. I think there was a press release on this, whereby we actually want to take it a step, push the envelope on our property selection. And we've worked with the two data scientists out of MIT to build a machine learning algorithm to help us on property selection. So it helps us forecast pricing, look at where the prices will end up, what areas are hot, what areas are slowing down. So we're building that data model in-house. And part of what we're doing right now is we're in-housing this model. The MIT students just handed it over around 3-4 months ago. In-housing that model and taking it a step further to ensure that all the properties that we choose, whether they're in Dubai or outside, have gone through rigorous selection process, but also not just human touch, human intelligence. It's actually going through machine learning, which is all about data. Open it up for Q&A. I'll just close this. Sorry, and
we have a good one. We have a good one from Mo on why liquidity is low in stake. And I'll jump in and address this one first. Really, so if you've seen in that slide that we shared, it's actually the only consideration that is at a disadvantage, if you will, versus REITs, public REITs specifically, compared to outright ownership. At the moment, yes, but it gets so low is because we have not yet launched our secondary market for you to be able to liquidate your stake. So that's coming. We are in the process of completing the whole setup and the legal framework to be able to transfer shares at the level of SPVs, which is how we give you guys ownership in the underlying assets. And so that is in the works. It's being finalized as we speak with both the DIFC and the Dubai Land Department. And that'll be coming very soon, so that basically you can, and our vision has always been, so you can transact in real estate faster than how fast you would be able to in the open market. So entering and exiting the asset class with speed is one of the key value propositions that we want to deliver to our customers. And so that's going to be coming. So that's why liquidity will then jump from low at the moment to medium. But I think this point also can't be said enough. We highly recommend all investors to look at this asset class that is unlike any other asset classes. Rami mentioned it really combines the best of all worlds. It works the best when you hold for over long periods of time to maximize your total return that's coming from both passive rental income that you can spend and capital appreciation from the growth in the market, the growth in the economy, and the growth in the liquidity also of the world. So that's the key consideration that you need to consider when you look at real estate. Try and keep a long-term mindset when investing in it. And if you need that liquidity back, we want to be able to provide that to you soon enough.
I hope we answered that question, Mo. I'll get on to the two questions that we have in the chat, and then Manar, if you want to answer the next one. So here from Rami is, how can we check from Dubai Land Department regarding the number of shares that we hold in the SPV? So good question. I'll tell you how the process works. So today, when you buy a property on stake, you're buying a property that is registered under an SPV. So as you said, so there's share certificates that are issued in the name of the SPV. The title deed comes out in the name of the SPV. So today, what you need to check with the land department, if you do want to check, and all our title deeds, you can check them. They're all, transparent. You can check them out. They're been issued from the land department. They are in the name of the SPV. And if you want to check how much shares you have, you can go to the DIFC website and check the SPV name, and you can see your name there. It's very transparent. We've been working with the DIFC and the land department for close to 2 years now. We're getting a lot faster in streamlining the process. They've been very supportive and very helpful in making sure that the entire backend is digitized. So to answer your question, you can check your SPV on the DIFC website, and then you can check with the land department that the title deed is in the name of the SPV that you own property. From Ali, can I get a golden visa if I invest with you? Stay tuned. We're working on something exciting. We'll definitely reach out to you, Ali, and everyone when that's sorted. What about the Abu Dhabi market or other Emirates? Great question, Eric. I'm a big believer of the Abu Dhabi market. As I said, I've been here for the last 16 years, so I've seen Abu Dhabi really grow from strength to strength. And it's a very interesting market. We've looked at properties there, and we have, potentially we might be listing something there very soon. We're to be very transparent, we're looking at Saadiyat. I think it's one of the best developments, not just in the region, but in the world. So we'd be definitely looking at something there. But we've been Dubai focused right now because of the opportunities that we saw here. We're closer to here, our ops team is here. So that's kind of why we focused on Dubai. Another emirate that we are actually looking into is Ras Al Khaimah, with the announcement of the Wynn resort opening there. We definitely see huge opportunity and potential. So we'll be looking at those two emirates very soon.
Question from Ilyas. Is it possible to include multifamily units in the available properties? If we're talking about commercial buildings, if they're one title deed, we can technically do those. It would improve, it would be a commercial kind of real estate play. As long as it's, residential ownership, it's kind of, can be considered as a commercial investment. I think, so we're currently stopped from doing pooling of assets, right? The DFSA does not allow us to pool assets in one SPV. As long as it's one title deed, technically we can, and we will be looking at these opportunities.
Do we expect a fall in the prices in real estate market now with the likely recession coming? So, no one can predict the future. Obviously, as the world slows down, we expect a slowdown in the price increase. One thing that I'll publicly say, and you can quote me on this and come back to me if it happens, is I don't envision another situation like we saw in 2008, 2009 in Dubai. I'm very confident that the market is very different. The one thing that I do see is the price increases that we've seen over the last 2 years will slow down, and we're actually seeing it, as I said. Growth capital in prime areas over last month we're up to a maximum of 1 to 2%, where they were going up 10 to 15% and up to 20% in the last 2 years. So I do see the growth slowing. One thing that I'll say, and this is very important, is when a slowdown happens, and because the interest rates have gone up, people, as I said, will switch to renting. So the rent prices will go up, and there's an opportunity today because rent prices will go up. So if you saw what happened in COVID, rent prices dropped. And people were paying low rents for a year, and then a lot of people started getting eviction notices because the landlords were like, hey, they're still paying COVID rent. I need to increase the rent for the market. So rent is always slow to catch up. So there's an opportunity today that if the market and capital appreciation or the prices slow down, there's an opportunity today to get into prime locations. And when I say prime, I talk about downtown Dubai, Palm Jumeirah, Business Bay, Jumeirah Islands, all of these places. But these prime locations, there's an opportunity to get in because as the prices slow down, you get the price increases slow down. You get in, and you also get in high rent. And as you know, in Dubai, there's rental contracts that are long-term for a year. If you're doing short-term, which we will be doing on some of our portfolio, you'll be able to get very high yields over the next 2 years if you're buying the right product, because you'll be locking in a tenant at a higher rent. And this is something that's very important for us when we go out and source properties in prime locations, and we have a bias towards prime locations. The fact is we always go for leases that are long-term because we want to make sure that investors like yourselves are getting that consistent return for at least a year, sometimes over 2 years. So this is where the opportunity that we see today. So I don't expect a fall. I see a softening, but I don't see a drop like we did in 2008, 2009. The market fundamentals in Dubai are a lot stronger. And I see with the prices of oil where they are today, there's a lot of liquidity in the market that actually helps Dubai. So Dubai will come out through this strong, and I don't see a drop. There's one question. Here. So to continue, Omar, why price of property will increase when buying power of people is decreasing? As I said, due to inflation. Yes, you're right. People will tend to decide to not buy properties and decide to rent. So as rents, as I said, will remain high for at least a year before we might see a softening. So it makes sense to get into rental properties today and make that consistent income.
We have a number of questions on the chat as well.
Yeah.
Rami, you want to tackle Rami's question on the best areas to invest in Dubai?
Yes. As I said, I would always say prime. I would say downtown Dubai. You look at downtown, it's unmatched anywhere in the world, and I'd like to be challenged on that. The downtown of Dubai has consistently showed, and again, I saw the market in 2009. Even in 2009, when the market had dropped, you could always rent and find a tenant, or whether it was short-term or long-term, in downtown Dubai and in prime areas. And then you go into Dubai Marina and you go into Palm. Those areas, regardless of what happens, and I genuinely believe this, I've seen this being in the market, you will always, that's why we're very biased towards prime. You'll always find someone to rent it, and you'll always be able to generate a return. So Palm, Dubai Marina, downtown Dubai, Business Bay, and there's some new areas that are coming up right now where we're starting to look at. If you look at all the Jumeirah front next to La Mer, which is developed by Miras, those areas which are waterfront, anything that's waterfront in Dubai will do well. So those are the main prime areas. I think you mentioned here, you answered that question on how we can sell our shares in the property. You answered that question earlier. If there are lower prices going forward, how Stake can act opportunistically to grab deals in the marketplace? That's an excellent question. So having been in the market for so long, we have excellent relationships with the developers, asset managers and brokers who have been consistently sending us real estate. So we have a great network in the market to be able to capitalize on properties. So recently we were able to get a property in Dubai Marina. It was a 3-bedroom where transaction prices were over 3.8 million, closer to 4 million. And we were able to get a seller who needed to get the money out at 3.2. So basically going out to the market, and now that we have kind of a reputation that we close properties fast, we pay on time, we will be definitely increasing our marketing on the seller side. And one thing that we've always focused on is, how do we bring investors to our platform? But one thing you'll see now, and we have an announcement to make very soon, is we're going to start focusing on the supply side and making that a lot more public. Because we want sellers today. If you're a seller in the market and you want to sell your property that's tenanted, you're looking, if someone's coming to buy it cash, it's probably taking 60 days. 1, 2, you have to work with 4 or 5 different brokers, you need to do 4 or 5 different viewings. And that sell down period will probably take you around 60 days, and it's a hassle. So sellers are starting to come to us saying, hey, you have a platform, you're regulated, you get me the money a lot faster than the secondary market is. So someone who has a tenanted property is coming straight to us. So we're going to be doing a lot of marketing, Ilyas, on this to start bringing those opportunistic real estate to us. And we're started to eye some right now, especially in prime locations, to be able to get those. Again, we will never jeopardize on quality. We will always get stuff in prime locations from reputable developers. Is it possible to make some of your internal market research available to the investors? Manar, do you want to?
We try and give out everything in the info memo on every property. You can see that in the documents section on the property details page. You'll be able to also access the financial projections. I think I mentioned this before. A key kind of benefit that we want to add to the market is increase the transparency and give you as much information to make a decision by yourself. So that market research, that due diligence, that goes into the selection of every asset that goes on the platform tends to be made, and it has to be actually disclosed and made available to you through the information memorandum and the financial projections. You also have the third-party valuation report that has to be also published at the time of listing of a property.
Do you look potentially, Christian, I love that question. Do we look at distressed acquisitions? Yes, we do. We work with some banks, and as you know, the market's been pretty hot, so there hasn't been a lot of distressed, if that's the word we're using. Having said that, on Emirates Auction, it's interesting you mentioned that. We have been in talks with them, and we should have something to talk about very soon that we can announce. Because yes, you know, there's definitely opportunity in the market when that arises. But I'll say one thing. Some of the distress that you always hear about, oh, there's distressed deals, are usually in locations that, or in buildings that aren't prime or aren't from the best developers. And the reason why I say that is people who are usually buying A-grade properties usually tend to have less distressed opportunities there. So, you know, and I'd like to mention that because, you know, some place like downtown and Amar development, let's for argument's sake, address downtown Dubai, you'll find less distressed opportunities there. Places on the Palm, you'll find less distress, especially over the last 2 years, because the Palm just went crazy. So people who've bought over the last 2 years, and especially end users, you'll find a lot less distressed opportunities. But having said that, yes, we're expanding into banks, and we are expanding, as I said, onto the seller side to find better opportunities, more distressed opportunities on the pricing side, for sure. Just one thing, Mo, you said, can you buy a whole property for yourself from stake? So you can't buy a full property on the platform. However, having said that, we've had some investors who have invested from international markets who said, listen, I love this platform, but I also want to buy a home for myself. And while we didn't do it on the platform, we connected them with our preferred suppliers, people who we trust in the market, people who we know that will take care of the investor and give them a good deal. So we've connected them, and we've had close to 3 or 4 transactions in the secondary market for outright purchases. So if you do have some specifications, please don't hesitate, reach out to us. You know, we'd love to assist you on that, on the requirements you have for your house. Can you buy stakes in stake?
Stakes. We get that question a lot.
We actually we just closed our funding round. We'll be announcing it very soon. You know, it was, you know, investors who've come in as shareholders. We never opened it to kind of the investors or smaller amounts to come in to the company. But you know, if it's something that we get asked a lot, I think it might be worth it. I know Manar had that idea around a year ago, and you know, we'd be open to it. So if it's something that you guys are interested in and being part of our journey, then we should look into it. You know, there's nothing more satisfactional and you know, more motivational than having investors like yourself believe in our journey and come in into being shareholders with us. I think, are there any more questions? Sit.
We reached time.
Oh yeah, no, there's one. Yeah, so outside scope question from Nabil. When will you put the previous webinar? So our third co-founder, Ricardo, had a very successful and famous webinar on the 1st of June. Unfortunately, we had a technical glitch and it wasn't recorded purely because there was a login issue, and we're very sorry about that. Having said that, we want Ricardo to do another one. You know, just to give you a quick background, Ricardo is our third co-founder. He's our CTO. He's very important and an integral part of everything that you see on Stake because we're a digital first business. So, you know, it was exciting for him to talk about everything that's coming up. So we'll get him to do another one, and I'll speak to him. He's actually flying to Dubai. He spends his time between Dubai and Portugal, so he's flying to Dubai next week, and I can speak to him to arrange kind of another webinar for you at some point. Any other questions? No? Okay. Thank you very much for your time. Thank you very much for attending. We just made it on the hour, so I think the timing was great. Really appreciate it. Please, if you do have any other questions or any comments or feedback that you guys would like to share with us, I am sharing myself and Manar's email on the chat. Please reach out to us. Don't hesitate. Also, please, our office is in the IFC. We'd love to have you come visit our office if you'd like. We are in Gate Avenue in Zone D, first floor. Please come in. We have the best coffee in the IFC, so please join us whenever you want. Ali, oh sorry, Ali, what benefit can I get if I invest with stake? Like, you know, if you're investing with 2,000, your profit is around 6. Yes, correct. So the returns that you make on the investment is equivalent to how much you put in. So the average yields that we're seeing on our properties are anywhere between 4 to 6% net. So whatever money that you put in, whatever money that you invest, you'll look to make around 4 to 6% of that per year, paid monthly. On most of our apartments, actually all our apartments so far, all our investments so far have been dividends paid on a monthly basis. So yes, you'd expect that those returns if you're investing 2,000. Thank you very much, everyone. Please, again, don't hesitate to reach out to us. Thanks so much for your time. I really appreciate it. And we look forward to hearing from you and growing with you. And thanks a lot for your trust and belief in Stake.
Thanks a lot, everyone.
Take care.
Have a great
Bye-bye.
evening. Bye-bye.